Hello everyone, this is Dan Veru from Palisade Capital Management. It's Monday, March 24th. Since my last video, I had described the negative impact growing uncertainties on trade, a budget showdown, and tax policy were having on stocks. But finally, valuations were becoming more attractive. Congress avoided a shutdown, and since March 12th, we've had a slew of economic data touching inflation, interest rates, consumer confidence, and on the Manufacturing and Services Purchasing Managers Index, or PMI. On inflation, both the Consumer Price Index and Producer Price Index cooled a bit, indicating that inflation is finally starting to come down ever so slightly. We don't want to make too much of this because it's only 1 month of data, but it is a good sign, and it's an important data point that the Federal Reserve takes into account when setting interest rate policy. Stocks, however, ignored the better news. On Friday, March 14th, the University of Michigan Consumer Confidence Survey was bad, but stocks nonetheless rallied about 700 points. On Monday, March 17th, global growth forecasts were downgraded, but stocks continued to rise despite the negative news. On Wednesday, March 19th, the Federal Reserve decided to keep interest rates steady for the Fed funds rate in a range of 4 to 4.25%, acknowledging that steady inflation, but cited uncertainties on the impact tariffs would have on inflation and on growth. Stocks on that news also rallied, and today, on Monday the 24th, stocks are higher yet again on better than feared purchasing managers surveys. When we last spoke to you, we had argued that stocks were at or close to a bottom, and we continue to believe that is the case today. Investors are digesting a lot of uncertainty, particularly on how policy changes will affect profits and the overall economy. But I want to make the following 3 points. First, stocks have had a bit of a bounce despite some negative economic data, but stocks tend to bottom not on good news, but on bad news. Expectations for growth in earnings, both in earnings and for the economy, have come down, and sentiment is now decisively negative, which in our view cushions the market from further declines. Second, as we stated before, this administration has come out swinging on tariffs in an attempt to right years of imbalances, while simultaneously looking to cut waste, fraud, and abuse within the government. We think we may be at the point of maximum uncertainty, and we would expect that the administration's tariff policy will become clearer in the coming weeks. Last Friday and on Monday, some chatter was indicating that tariffs will be less broad and more targeted, and the markets, again, are responding positively to that notion. For example, a fixed tariff has a bigger impact on the economy over a targeted reciprocal tariff, and we think ultimately that's where the administration is going. Third, this administration is also focused on deregulation as a theme, and as members of his key cabinet continue to get seated, we believe that you'll see the positive effects of deregulating financial services, energy, and other areas, and they could be very highly stimulative, offsetting any negative impacts from trade. While it's difficult to know if we've made a bottom for stocks, many companies in a variety of different industries are now much more reasonably valued than even just a month ago. Most of the damage in stocks has been in the technology sector, but other sectors have not been impacted very much at all. Over the months, we do think that there will be clarity and an environment that will improve for profitable, well-managed companies. Thank you very much for your time today.